All right, let's talk about building a smarter portfolio. Over the next few minutes, we're going to break down the core principles of modern investing. We'll cover the absolute fundamentals of risk and return that you need to know to build a stronger, more resilient portfolio. So, let's just dive right in with the big one, right? The question every single investor asks themselves. How do you get the best possible return without taking on a terrifying amount of risk? It's the ultimate goal, but, how do you actually do it? Well, think of this explainer like we're on a construction site. We're going to hand you the essential building blocks. The core idea is that once you put them together, create the foundation for a really smart investment strategy. So our very first building block is return. Now, it sounds simple enough, but really understanding what it means is absolutely crucial. It's about way more than just seeing a stock price go up. You see, to get the real story, you have to look at the total return. This isn't just about the price change, what they call the capital gain. It also includes any income you got along the way, like dividends from a stock. If you ignore that income, you can get a totally skewed picture of how your investment actually did. And here's where we need to get a little more precise. If you're looking at returns over a few years, a simple average, the arithmetic mean, can actually trick you. What you really want to look at is the geometric mean, because it takes into account the incredible power of compounding. It shows you what you actually would have earned if you just bought something and held onto it. Okay, on to our next building block. You really can't talk about return without talking about its partner, risk. And for a lot of people, risk is just this vague, scary concept. But in the world of finance, it's something we can actually measure. The key metric for risk is called standard deviation. Now, don't let the name intimidate you. All it's really measuring is volatility. Think of it as the bumpiness of your investment journey. An investment with a high standard deviation has returns that are just all over the place, which makes it a lot riskier and harder to predict. So let's see how this plays out in the real world. If we look at historical data, all the way from 1926 to 2008, big company stocks gave an average return of about 9.6% a year. In comparison, much safer government bonds, they returned about 5.7%. So pretty clearly, stocks offered a bigger reward. But, and this is a huge but, here's the other side of that coin. This chart just perfectly shows the fundamental trade-off. To get that higher return from stocks, investors had to stomach way more risk, a volatility of over 20%. That's more than double the risk of bonds. It's the oldest rule in the book. There's no free lunch. Higher potential returns mean you have to accept higher risk. Okay, so we've got our two main building blocks, risk and return. But now it's time for the secret ingredient, the thing that ties this whole thing together. Because the real magic isn't just in the assets themselves, it's in how they relate to each other. And that secret ingredient is called correlation. It's a simple score, from -1 to +1, and it just tells you if two things tend to move in the same direction, opposite directions, or if they have no relationship at all. Trust me, understanding this one little concept is the key to everything. So a correlation of +1 means two assets move perfectly in sync. Think of two dancers doing the exact same routine. One zigs, the other one zigs. One goes up, the other one goes up. -1 is the complete opposite. They're like a seesaw. When one side goes up, you know the other side is going down. And as you can probably guess, this is an incredibly powerful tool for balancing out a portfolio. And a correlation of 0. That just means there's no relationship at all. Their movements are totally random and independent. Knowing what one is doing tells you absolutely nothing about what the other is going to do. All right, now for the really fun part. We're going to put these building blocks and our secret ingredient together to see the true, almost magical power of what's called diversification. This is where we actually start to construct our portfolio. Okay, check out this brilliant, simple example. You've got two companies. Beachwear Co. makes 20% when it's sunny, but nothing when it's rainy. And DVD Rental Co. is the exact opposite. Now, on their own, each one is pretty risky, right? But what happens when you put half your money in each? Because they have that perfect negative correlation, your portfolio makes a steady 10% no matter what the weather does. You've basically used correlation to engineer risk right out of the equation. Okay, now let's take this into the real world. Let's say you just invest in the S&P 500. Historically, the risk, or standard deviation, of that portfolio is about 16.21%. Now have a look at the risk for a portfolio of stocks from emerging markets. Whoa, at over 33%, it is way more volatile. A much riskier asset, for sure. So here's the million-dollar question. What do you think happens when you take your S&P 500 portfolio and add a small 20% slice of that much riskier asset? I mean, common sense would tell you that the overall risk has to go up, right? Get ready for this. The risk of the combined portfolio actually drops. It goes down to 15.10%. It is now less risky than the S&P 500 was all by itself. This is the magic of diversification. Because those two types of stocks don't move in perfect sync, adding the riskier one actually helps smooth out the whole ride. I mean, isn't that just incredible? So we have the building blocks. We have the secret ingredient. The last step in our project is the blueprint. This is all about taking these powerful ideas and figuring out how they apply to you, the individual investor. See, the perfect portfolio for you depends entirely on your personal relationship with risk. Are you risk averse? Someone who prefers a sure thing, even if the payoff is a bit lower? Or are you maybe a bit risk seeking, someone who actually enjoys the thrill of uncertainty and the chance for a huge win? There's no right or wrong answer here, only what's right for you. And that really brings us full circle. We've given you the toolkit. You know how to think about total return, how to measure risk, and how to use the incredible power of correlation. So now the question is for you. How are you going to use these building blocks to construct your own optimal portfolio?